It's time for the Phil Ferguson Show.
Benvenuti a tutti, mi chiamo Phil Ferguson e tutti state ascoltando lo spettacolo di Phil Ferguson. Hello everybody, welcome to the show. I'm Phil Ferguson and you are listening to the cleverly titled The Phil Ferguson Show. I forgot to put in cleverly. I'm going to have to look up forbici. No, that's scissors. Whatever. I'll figure that out for next time. Just practicing my Italian a little bit, trying to keep the show a little fun. I've decided recently to start having like online tutorish-y, conversationally thingies. So I found a site for a few bucks. I get 25 minutes speaking to not only a native Italian, but a native Italian who also knows English, and their profession is to teach English speakers Italian. So it's really good practice. Having a great time with that on my quest to become fluent in Italian. I'm getting pretty close, I think. I can normally have a conversation and very rarely get lost. So that's good fun. In this show, we've got a really fun, amazing, and a little bit long interview, but I think you're going to like it. It's with Rosemary Batt, and she is one of the co-authors of a book on private equity funds. I've talked about them in passing. I've talked about new, I think it was a Department of Labor ruling that at some point in the future you can have private equity funds inside of your 401k. The really short answer, please don't do that. Don't select private equity funds. Don't invest in private equity funds, ever. And of course, the other option that may show up sometime this year in your 401k is the chance to buy an annuity inside of your 401k because the current administration thinks that it's okay for really big and, ethically challenged. Yeah, ethically challenged organizations to part you from your money are being allowed more opportunities to get their hands on your money. So try to stick to index funds. My preference is Vanguard, but Fidelity has quite a few good ones now. Schwab has some. There's plenty of places to go get good investments. I am really bummed that these companies have figured out a way to get their hands on your money inside of a 401k, 403b, 457, Keogh, Simple, SEP, maybe a couple of different ways. Just be on the lookout. Make sure you understand what you're investing in. If you don't understand it, that's cool, yo. Don't invest in that. I got an email. Someone sent me a plan, something kind of like what I do where I suggest X% in this and X% in that from another person, and they wondered if I would talk about it on the show. And I thought about it, and I think I decided, no, I'm not going to do that. And the problem is that if I give you a different set of percentages, one might be tempted to believe I think those are good percentages to use, and then the listener has to differentiate between the percentages I recommend and the percentages some other person recommended. There's all kinds of stuff out there online. One of the big problems with a lot of presentations that I've seen is that they include either intermediate or long-term bonds or some portion of long-term bonds here in the United States, which can be problematic if interest rates go up. So anyway, a little teeny investing-ish kind of topic. I'm going to talk about international funds and what happens if the dollar goes up or down. So that's a little mini investing skeptically mailbaggy thing. And then right after that, we're going to go into the wonderfully, delightfully long interview with Rosemary Batt. where we're going to talk about private equity funds. So strap in, boys and girls. We're going to have fun. I get questions. Yes, I do, and I have a new one in an email. And of course, if you have questions, whether it be about investing or religion, I can give it a try to answer it. And if it's interesting, it might even make it on the show like this topic is doing. Someone emailed me about international funds, and of course, this is relevant to people that live in the United States and buy funds around or with stocks from other countries. This is very challenging when people contact me from other countries, Canada the most frequent, probably because of its proximity, and other speaking countries, and sometimes other countries around the world. And I am much less confident in my advice on almost everything in money when you're in another country. So just keep that in mind if you're listening from another part of the planet, and people do. So thank you for listening. But if you're in the United States and you're heeding my suggestion to have a reasonable portion of your investments in international stocks or bonds, this question may be relevant to you, and it's something that maybe you thought about yourself. And the basic question is, what happens if the currency rate of exchange changes? So if the dollar gets stronger, do foreign currencies get weaker? And it doesn't really matter currency to currency like the euro to the yen. It's all about dollars because you live in the United States. When you add money, it's in dollars. When you take out money, it's in dollars. So it's all about the dollars. And the Vanguard International Funds and the Vanguard International stock and bond funds, I happen to know that they do hedging strategies where they buy options and puts and calls and things in foreign currencies, a basket of foreign currencies, so that if there is a 20% increase in the dollar, which changes the value of your investment, you're covered for that. Because when you invest in an international fund, you want to invest in international stocks. You're not doing currency trading. If you wanted to do currency trading, there's different ways to do that. A, I don't recommend it. B, I'm not even sure, but it wouldn't be that hard to figure out with the Google. But trading currencies in the long run is a zero-sum game because you're going to go in and out of currencies, and it's a zero-sum game minus all the costs associated with that. Trading costs, transaction costs, fees, penalties, whatever the costs are. So it's another one of those things that I don't consider it investing. Now, Vanguard does that as a hedging strategy to make sure that you are basically getting what you expected in US dollars, not in a basket of other currencies. I would guess, and this is something I'm saying guess because I don't know, I would guess most international funds sold to customers within the United States are going to be hedged against foreign currency fluctuations. I do not know that as a fact. I don't know what the percentage is. I would go with most. It seems pretty safe. But if you buy a fund from someone other than Vanguard, you might want to call and ask someone at the company, is it protected against change in currency rates, currency rate fluctuations, hedged against currency rate fluctuations? And that way you know that the results that you're going to get are going to be based on the stocks or the indexes that fund follows. Otherwise, like I said, you're doing currency trading, which I don't think is a good idea. So that's how that works, and that's how you're not going to get wiped out if there's a sudden big change in the dollar's value compared to the rest of the world.
The nun gets up in the morning and leaves and walks down the corridor. And another nun looks at her and says, it's a difficult thing to say, another nun, and says, you got out of the wrong side of the bed this morning. And she goes on down, and another nun says, "You got out of the wrong side of the bed this morning." And this happens 15 times, and by then she's livid. And she meets the Mother Superior. And the Mother Superior is just about to open her mouth, and the sister says, "Don't tell me that I got out of the wrong side of the bed this morning!" And the Mother Superior said, "I wasn't going to say that. I was just going to say, what are you doing with the bishop's shoes on?"
The Phil Ferguson Show is for educational purposes only. Nothing said on the show should be interpreted as personalized investment advice. Your investment should be based on your situation, and you should consult with your financial advisor before taking any action. The show may contain ads. These ads are placed into the show by the hosting company after I finish recording and editing. I have little control over the content of the ads, and you should not assume that I support their products or claims. If you choose to support the show via the new Patreon page, that support does not create an advisor-client relationship.
You're listening to The Phil Ferguson Show.
All right, everybody. As promised earlier, one of the authors of a book called Private Equity at Work, When Wall Street Manages Main Street, I have with me Rosemary Batt. How are you today?
I'm good. Thank you.
And just make sure, I want to mention for full credit, your co-author is Eileen Applebaum.
That's right.
Excellent. Well, we have you, so we're going to focus on you. And I do want to, for listeners' disclosure, mention that this book is a little old. It's from late 14, early 15. But quite frankly, it's the only book I found, and I was delighted after I listened to it, that really goes into detail. And it's not a hit piece. There are points where you guys actually point out how private equity works and benefited people, and you pointed out cases where it doesn't work. And of course, I can throw in my opinions anytime, but if you have thoughts on top of the data, of course, we can talk about that. But how did this book come up as an idea? Oh, before we even get into that, what do you do, Rosemary?
So I'm a professor of management and employment relations at Cornell University, and we're in a specialized school called the Industrial Labor Relations School that provides basically an interdisciplinary social science degree for students interested in business. So it's a kind of pre-business, pre-law, but also pre-real world of work. So people who want to go into the public sector or in the nonprofit sector. So it's a general education in the social sciences to orient people to working in the real world of business and employment relations.
I almost said it's a program that teaches you about reality. That's nice, and how things work. So I just wanted to make sure the listeners knew a little bit of your background.
Yeah.
And now, of course, how do we get to this book?
Yeah, so I had been doing research on industries, on industry productivity, and the things that make not only industries and companies successful, but also which create good jobs. And in that context, we look for kind of mutual gains. Where can we find positive business practices that will benefit, the stakeholders as a whole? And during the lead up to the financial crisis and the financial crisis, we looked around and said, there's a problem here because many businesses are failing. We're seeing a real impact of the financial sector on Main Street companies. And we're very concerned that we as professors don't do enough to do research and teaching around the impact of financial investors on Main Street companies. And so in looking around, we said, well, we can't do the whole financial system. So let's take one example of where investors really do affect the way that businesses are run. And with that, we came up with private equity, which is as many of your viewers may know, it's a private equity firms create investment funds and then invest in Main Street companies. And so in doing so, they take the company private. They use a lot of debt. They buy it out completely. They take it private. And then they are the key decision makers in how that company is run. So this is an example of what we would almost call an extreme shareholder model of the corporation, where a couple of decision makers who are the investors and owners are making all the decisions about the company's strategy and operations.
I'm going to put the brakes on because we've got a lot of concepts that you covered really quickly, and I want to make sure. So a fund is created. So someone somewhere says, I'm going to make a fund, and it's an account or a bucket somewhere where people are going to throw in money. Who's putting money into this fund, into this bucket?
Right. So the private equity firms attract investors who are institutional investors, such as pension funds, endowments, maybe insurance companies, and wealthy individuals. So fully 1/3 of the investors are pension funds. And that's a really important fact that we can get to later.
Yeah.
But these are institutional investors, and 1/3 are pension funds.
Okay. And so sometimes these funds market themselves to just regular individuals, or do you have to be a qualified investor, or is that changing?
So that's a major issue occurring right now that we can talk about.
That's why I asked.
Up until just a month ago, IRAs, 401ks could not invest in private equity. But the private equity industry has been working very, very hard over several years. They first introduced the idea back in about 2013 to allow individual retirement plans to invest in private equity. We think that's very risky, and I'm very concerned about that. But that is where the direction that private equity firms are going in. It's also not clear why they need to go there, because they have about $1.5 trillion in assets that have not been committed, have been committed by their investors that have not yet been invested.
Wow.
So they are not really cash short. But they are moving in the direction of attracting the IRAs and the 401ks.
And I will jump in, and this is not your opinion, I mean, unless you agree with me, but my opinion for anyone that's listening, if your employer's plan, 401k, 403b, Simple SEP, KEO, whatever it is, if you are allowed at some point in the future an opportunity to invest in a private equity firm, don't do it. That's my short answer. We will get into some of the reasons why I have problems with that. I know that's not your answer necessarily, so I didn't want to put words in your mouth. So they're going to collect money, but these people that set up this private equity fund, they must put in a whole lot of their money, right?
No.
Oh.
They put in almost nothing. So the structure of a private equity fund is that the private equity firm and their general partners, there's a team that oversee these funds. They launch a fund, and they put in about 2% of the entire 100% of the fund. Yes, they put in 2% of their own money. Investors put in 98%. The overwhelming majority, about 80% of private equity fund money, is put into what are called leveraged buyouts. So that is the dominant form. They may invest in like minority stakes, just like investing in the stock market.
Yeah.
But that's not the real way that they invest. So for all intents and purposes, 80% of private equity money is going into what are called leveraged buyouts.
All right, so before we go into more subjects, I'm so sorry to cut you off. What does this mean, leveraged buyout?
Right. So I was going to explain that.
Awesome.
A buyout is when we're going to buy out the stock of a company, but we're going to do so using a lot of debt. And so the business model is that I will buy a company with, say, 70% debt, and then I will pay the rest of it with 30% equity that comes from that private equity investment fund.
Now, how big a company are they buying?
Well, it varies. So there are very small private equity funds that maybe only be 25 million, and they go up to mega billions. And so the way to think about the private equity industry is that they have all sorts of segments, like any industry. And the majority of the firms are actually very small. The majority of the firms and the funds are very small. But the majority of the money is in the larger firms that do very big buyouts of companies.
Fair enough. So I want to give a mathematical model here. Let's say we're going to buy a company that's worth $1 billion.
Mm-hmm.
And so of that billion, 700,000 may come from debt, and we haven't gotten into the details of that yet. But 30%.
700 million.
Yes, thank you.
1 billion.
Thank you. 700 million is going to come from debt somehow. We haven't got into that. And 300 million comes mostly from limited partners who are putting money into this fund, and only 2% of that 300 million, which is what, 6 million? So
under 1% of the value of the enterprise is being paid for by the private equity fund partners themselves.
So the general partners, the owners and the people who are going to take over this company and run it and manage it, might have less than 1% of all of the money at stake is theirs. And then you have limited partners, which have 30% of the ownership of the company, or at least 30% of the money that was theirs. And then 70% is debt. So the general partners borrow 700,000?
700 million.
God, thank you so much. The general partners are borrowing 700 million. And I meant this as a setup question because the general partners aren't borrowing the 700 million. Who is?
Well, they are using the collateral of the company they're buying to take out the loan. And then the loan goes on the company itself. The private equity firm is not held liable if anything happens. So the debt goes on the entity, the company they just bought.
So in our example, they buy a company for $1 billion. 700 million in debt is added to the company they just bought for $1 billion. Almost all of the other 300,000 is the limited partners, and again, the general partners have almost no skin in this game. Is that correct?
Right.
Okay.
So but once given that they only put in less than 1%, they also are charging the limited partners or the investors, charging them 2% annual fees and the investment fund.
Okay, because they're so smart and genius and make all this money, the limited partners have all agreed in probably a 100-page or 400-page contract to pay 2% of their money is eaten up every year to the general partners.
Right. So if you think about, say, a fund is, we'll just say $100 million.
Yeah.
Then and they have to invest. The partners have to commit that money over 10 years. So they're paying 2% annually. So 2% of 100 million means 20 million right off the top.
Now I think
goes
it's
to the private equity firm.
Oh, over the 10 years.
Mm-hmm.
Yeah, so it's $2 million. 2 million a year over 10 years. And is that only if they're successful and make money, or do they get that 20 million in total regardless?
Regardless.
Okay, so they're putting in 2% of the fund, and so they're gonna be even after 1 year, and the next 9 years it's just cream. Now they're doing some work, but they're making a lot of money.
Yeah, they have to do all the due diligence of finding the companies, of, negotiating the deals, et cetera, et cetera. The key also, and this is why the financial model, it's called 2 and 20. The investors put in 2% into the fund
every year.
And then when the companies get sold, so the private equity firm goes out and buys a company, takes it private, and they try to sell the company in a 5-year period. And when they sell the company, presumably they've made what they call outsized returns. They promise to deliver higher returns than the stock market, and then they're going to repay the investors. However, when the profits come in, after a certain hurdle that's usually 8%, the private equity firm gets 20% of the profits.
Wow. So they get 2% every year, and then 20% of all the profits, even though they only started with 2% of their money.
Yeah.
Okay. I just want to make sure that was clear.
So we call this a low-risk, high-reward model for the private equity firm.
Yeah, sounds pretty sexy to me. This is one of those things that we mentioned in a pre-show when you and I were talking, that annuities often make more money for the company offering the annuity than the investor. And part of me is impressed by the brilliance of this, but I'm also very upset because it doesn't sound like the average person is going to make a lot of money. What's the data say on that?
Well, if you take the fund performance data on private equity, there's a dispute because private equity uses a certain measure that all academic economists have said is a faulty measure.
The IRR is what we're talking about here?
Yeah.
Yeah.
So this is called the internal rate of return, which is a rate that is often used within companies like to estimate the cost of a project, right?
Yeah.
But that's a very different scenario than here. We've got investors who are investing in a fund, and they want to look at their investment relative to the returns relative to what they might get in a publicly traded or equivalent market, right? Because they would have the option of putting that money, say, in the stock market or an investment index fund or into private equity. So the correct measure that is used by all of the top finance economists, it's what's called the public market equivalent. And what that means is you want to compare the private equity returns to the comparable returns from like a similar set of companies in the public market. So it might be the S&P 500, or it might be the Russell 5000, but an index of funds. And then,
are you going?
If I can just add one thing.
Yes, please.
Because these private equity investments are illiquid, i.e. they have to keep them in over 10 years, the private equity fund really should make at least 3 percentage points or 300 basis points over the S&P 500.
And that was exactly what I was going to ask. Thank you for doing that magically for me. You can just talk, and I don't even need to ask questions. But so if I could make 10% a year, theoretically, in the S&P 500, but I have the advantage that within a day or two, I can add or take out any amount of money that I want. These private equity investments, and this might even apply with people in 401ks, when you're adding money in, they're putting all this money into a pool until it's big enough, which who knows how long that takes. But then they have to buy companies, play with companies, fix companies, manipulate companies, whatever magic that they do. And 5 to 7 to 10 or even longer years, you may have to wait before you get all of that money back. And you're saying that the theories all suggest that an additional 3% might be, I'm not sure that I'm convinced, by the way, that that's enough, but an additional 3%, so 13% per year, might be the reasonable rate of return that would compensate you for locking up money for a decade. Are they providing that?
Right. So all of the best, and I'm not a finance economist, but we are economists, we read the literature, and the mainstream economists who are not, some of who are pro-private equity, they're not certainly necessarily critical. They do the math, and they're very accurate. And what that data shows, and those are studies done by people at Chicago, at MIT, at the top universities, they show that until about 2006, the private equity funds were beating the stock market somewhat. From then on, and then you see basically in the 90s they did better, in the 2000s they didn't do quite as well. Since 2006, the median fund has not beaten the stock market.
Okay, so
now,
you could do better by not even trying.
There are still some in the top quartile that may be getting that extra 3 percentage points. But the overall private equity returns have been going down, and now the median fund does not beat the stock market.
Fair enough. And we've got a lot of complicated things to go over, and if we end up going too long, just tell me and we'll wrap up. But so in our theoretical example, they bought a company for $1 billion. $300 million came mostly from limited partners. $700 billion is borrowed from banks, I guess, and the company is bought, and now it's owned by the general partners and the fund. And if the company just goes kaput, who pays back the $700 million debt?
Well, the private equity fund partners certainly don't. So if there is financial distress or bankruptcy, then it goes to bankruptcy court, or they often may do a bankruptcy deal in which basically they tell their creditors, look, we're going to go bankrupt, so why don't we do a debt exchange, or why don't we do, we'll give you, 30 cents on the dollar, and we'll renegotiate for a longer loan.
And if I recall correctly...
But it's the creditors who take the haircut.
Yeah, 30 cents on the dollar is a haircut. You're very, very kind. And I think I read sometimes that when these companies are on the verge of financial collapse, sometimes the general partners or their colleagues, friends, cohorts at other private equity firms go in and buy the debt at 30 cents on a dollar. And so when the company gets reorganized, they still own it even though it went bankrupt. Am I saying that right?
Yeah, it has occurred. What the difference is it can be within the same private equity firm, but two different funds.
Oh my goodness!
So an example is Sun Capital owned Friendly's ice cream.
Yeah,
and it had used a lot of debt. It had, taken out assets, and the company was doing badly, and it was going into bankruptcy. And so before it did, a second fund owned by Sun Capital went in and bought the debt. So that then when the company went into bankruptcy, they got rid of the pension fund, they got, rid of the debt, and then Sun Capital, but fund number 2, or whatever the fund was at the time, now owned Friendly's, but without any of the debt and without any of the pension liabilities.
All right. That one of my, oh my God, the most amazing, I don't want to say favorite because I really dislike it, pension funds, which are becoming less and less of a thing. And I think that's good. And this might be why some of these funds are having trouble making money. Let's talk about retail, if you don't mind. They buy a retail company, and they often split it into two, and they have retail operations as one company, and then a real estate company or some other entity that gets all of the land assets. Does that sound right so far?
Yep. We call it an OpCo-PropCo, operating company, property company split.
So the property company owns all the property and then starts charging rent to the operating company, which is under all the debt because all the debt stayed with them. And they're struggling to pay their mortgages on land that they used to own themselves.
Correct.
Okay. And then all the employees work at the operating company, and they all have some nice pensions that have built up over the last 20, 30, 50 years. And you mentioned, and I already know how this goes, but sometimes the pension funds fail. Walk me through that. How does that happen, and how do the employees get all of their money?
You're talking about the pension funds that are in the company that goes bankrupt?
Correct.
Yeah, so the employees don't. I mean, if when it goes to bankruptcy court, the employees' pension fund is like the last in the list of they're the unsecured creditors. Usually what happens is that the company or the private equity owners will dump the pension fund on this quasi-governmental insurance company that is called the Pension Benefit Guarantee Corporation. And then they are responsible for taking over the pension fund. However, then the employees get a much less substantial pension. So they will still get some pension, but it may only be 50% of what they were originally guaranteed. So either the pension fund, they lose it altogether, or it will go to the pension benefit fund corporation.
And when it goes to that quasi government agency, that's basically funded probably by insurance premium payments by companies, but a lot of that money comes from the government, from taxpayers. And so the government and or the taxpayers are helping to bail out the pension fund so that the employees don't lose 100% of the money, but the operating company gets to write off or just walk away from that obligation? Is that how that works?
The operating company just walks away.
Okay. And of course, the property company, they have nothing to do with it. They don't owe anything. So even if the operating company completely folds, the property company still owns all the property. Is that also true?
Yes. But the other, of course, the other thing is that the reason that, so when we talk about how does private equity make money, there are many ways. One is that, you can do some efficiencies, you can cut costs here or there, and there's kind of low-hanging fruit, improve the accounting system or whatever. But that is true mainly of smaller companies that maybe, a private equity firm buys. But when you get to, $500 million or $1 billion in a private equity buyout, those companies are already quite sophisticated, and they've cleaned up their act whenever it was possible.
Yeah. Right.
They've done a lot of that work themselves. So it means that when a private equity firm takes them over, they're looking a lot for assets to strip, and they want to try to get their money out as soon as possible. And so one is to break up the company and sell off the property. And though that money goes immediately back to the private equity owners and their investors as a dividend. So in some cases, just that sell-off of the property will pay back the equity investment. I'll give you an example. One was Red Lobster. There was a buyout several years ago. Red Lobster wasn't doing so well, and it was bought out by a private equity firm. And the very next day, the private equity firm sold off, I think, 500 properties and paid itself back so that it wiped out the equity debt and more in one day, then it doesn't matter, right? I mean, so you've already, then everything else is icing on the cake.
Yeah, and the whole thing could go completely bust and be worth nothing because you already got all your money back plus some.
Yeah, and then
Wow.
there are other things that can be done. I mean, I think in talking about retail, this is just to put a couple of factoids on the table. One study that was done last year found that between 2012 and 2019, 10 of the largest 14 retail chain bankruptcies were private equity-owned chains.
Yeah, and we're talking
And that
about like
led to
Toys R Us.
Yep, Toys R Us, but many more.
Yeah.
And that led to a loss of 600,000 jobs directly, just in the stores, and then an estimated 700,000 jobs in related businesses such as suppliers and distributors and the like. Now, that's just one study. Recently, in April, there was a study done, and this is relevant to the COVID period, that showed that 27 of the 38 retailers with the weakest credit profiles right now, more than 70% were owned by private equity, according to Moody's. Now, and these are like Sports Equipment Seller, Academy Sports and Outdoors, 99-cent stores, Guitar Center, lots of different stores. And then if you go to the story of J. Crew, which went bankrupt, and Neiman Marcus, they were the private equity owned and the first to go bankrupt in the COVID-19 era. And let me just give you an example of how this property sales and goes further than just selling the property underneath the company. In the J. Crew story, the private equity firm had bought like a holding company that included J. Crew, Madewell, and a couple other brands. It used 70% debt loaded on the company. It then split the company into different brands and sold the better brands and paid itself back.
Wow.
Then it split the company into the operating company J. Crew and the J. Crew brand, which is its intellectual property, and set that up as a new subsidiary located in the Cayman Islands that was inaccessible to the creditors.
Yeah.
Then it put all the debt on J. Crew, and J. Crew went bankrupt. And so by that time, the creditors could not get access to any of the valuable assets.
Wow. Now, is Hertz involved in one of these things?
The Hertz story is also one. It's also a private equity story, and I don't have. Yeah, I'd have to go back. I don't have the factoids at my fingertips, but it's a similar story. It's a.
Go ahead.
Go ahead. Well, I just say that in underlying all of these stories is this issue of loading a company with a lot of debt. And because you're loading a company with so much debt, then you can get faster returns because your returns are on your own equity.
Right.
And then private equity has more in its investment fund to spread around and diversify its risk, so that its eggs are not in one or two portfolio companies, but it's spread around. So if a couple of portfolio companies go bankrupt here or there, that's not going to affect the overall returns on the private equity fund.
Would it be fair to say that the goal of a private equity fund is not necessarily to destroy a company, but the company that they buy, its success or destruction is incidental to the desire of the private equity fund to make the most money?
Yes.
Okay.
Because, just let me clarify that.
Yeah.
So companies want to maximize profits at the company level.
Right.
Right? But private equity firms want to maximize their profits at the level of the private equity firm. And if they diversify their risk across many different companies and funds, then they're only looking, their bottom line is the private equity firm. And so each individual portfolio company, they're managing for cash flow. They're not managing it to maximize profits.
Yeah. I hear you. So, and sometimes, and it's rare, and you had a few examples in the book, but they buy a company and they fix it and they actually make it more valuable. And those are great marketing stories for their funds. But it seems like the predominant result is companies get split apart, ripped apart, stretched, folded, deaded up, the pensions go away, people get laid off, jobs get eliminated, giant pay cuts, and the general partners still keep rolling in the dough as they leave behind them this wake of economic destruction. Engines that used to hire hundreds, thousands, tens of thousands of people are now destroyed, and there's just desolation left behind them. Am I overplaying this?
Well, I do want to point out in what we do in our book that I thank you for mentioning it, how balanced it is. We actually won an award at the Academy of Management for one of the best books published in the year we published it, because, and this is in the Professional Association of Business Schools, because we were really even-handed. And what we wanted to show is that the smaller private equity firms and the smaller funds, they can't use that much debt because small companies don't have as much collateral that you can just throw a lot of debt on them. And so they have to be more creative in helping those companies grow. But also they have more opportunities, right? These are small companies. They're not that sophisticated. The point is that the majority of the capital in private equity funds is going to these very large buyouts where you can use a lot of debt. So it's the debt, it's the use of expanded debt that really is the problem.
What are the names of the largest private equity funds that you know of?
So the firms are firms like Apollo, KKR, Cerberus, Carlyle, TPG. I could go on, but there are really, those are the major ones. Blackstone, if I didn't mention them. These are the really big funds that have been operating, and I do want to point out that some of these funds have been operating since the 1980s, when this so-called leveraged buyout model was first got going, and KKR, Kovitz, Kravitz, and Roberts actually were the ones that created this model. And it was kind of put aside at the end of the 80s because all of the scandals around, the junk bonds and the Milliken and the rest. But then they kept on a bit beneath the radar, and they merged particularly by the end of the 90s and then took off in the 2000s.
Well, I have a client who had a private equity fund that just merged with KKR and allowed a window for you to take your money out. And for her, I was able to get her 50 cents on the dollar out of her initial investment. And we were actually pretty happy with that because she had been waiting years and years and years to get her money. And it's not just that she only got 50 cents out. She got 50 cents out when her dollar could have turned into $3 or $4.
Mm-hmm.
So that's absolutely staggering. I don't want to take all day, but I probably could if you let me abuse you. But what have we not covered that needs to be discussed, or is this enough for the average listener to process. What do you think?
Well, I would just say what I do want to mention, because I think it's so central to the current period we're in, is private equity has moved really big time into healthcare. And the private equity strategies in healthcare are, some of them are really of great concern. And I want to highlight a couple. I actually have a new paper out on private equity in healthcare with
Sure.
Eileen, and I can send you the link, but it's an
I would
report,
love it. And you can take as much time here as you're willing to do so. So whatever you want to cover.
Okay, well, it's a report that is on the website of INET, which is the Institute for New Economic Thinking.
Okay.
So you could Google INET and private equity in healthcare. A couple things I want to signal. So one of the big things is that private equity has been driving the consolidation of the industry. And one way they do that is they buy smaller entities, like a doctor's practice. They create a platform, and then they keep adding other practices to consolidate their power, their market power, into bigger and bigger entities.
All right.
Now, one of the biggest areas that has been of concern this year is that private equity firms have been at the leadership of surprise medical billing practices. And many people may not know of it, so let me just say
yes,
it
please.
quickly if I can.
You have all the time you want.
Basically, as hospitals have been under financial pressure, they have needed to outsource and find ways to cut costs. And so many of them started outsourcing their emergency room services. Now, what that means is the emergency room will still be at the hospital, but they will hire a third party to run it, to operate it.
I'm worried where this is going to go.
So this entity will come in and they will oversee the staffing, the hiring, the management of the emergency room. Now, normally if a person with an insurance goes into that hospital, their insurance will cover it because the insurance company has a contract with that hospital. But their insurance company does not have a contract with the third-party vendor.
Oh, my goodness.
Who runs the emergency room.
Yep.
And so many people who go into the emergency room may find that they get what is called an out-of-network bill because the staffing company that is running the emergency room does not have to comply with network charges and can charge whatever they want.
Wow.
And so then the person will get what is called a surprise medical bill. And it can be thousands of dollars.
Well, tens of thousands.
More. Now, why is private equity of interest? The two major staffing companies that run emergency rooms are owned by private equity. One is called Envision Health. It's owned by KKR. And the second is called Team Health, and it's owned by Blackstone. They control 30% of the emergency room staffing market. And they, in the past year, have spent millions and millions and millions of dollars lobbying against legislation in Congress that is trying to cap these surprise medical bills.
So I want to
devastating for people.
It is. So are you saying that if I go to a random hospital, there's a 30% chance now, and it's probably going to get worse, that its emergency room, which I think is part of the hospital, but the emergency room, there's a 30% chance that it's run by some other organization?
Well, no, actually, there are probably a majority of emergency rooms now that are outsourced. but 30% of that market is owned and run by private equity.
Oh my gosh.
And they have been found in the academic studies. It is those two companies that have been found to be most guilty of the high surprise medical bills.
And that's one of the problems I've always had with medical billing. Where else in my life do I go and have no idea, absolutely no idea what the price is, what I'm going to pay, what the markup or markdown is going to be? I mean, I've seen these bills where it's $5,000, let's say, for some service, but the contract rate is $1,200, and then the insurance pays $600, and I'm out $600. But if I had gone on my own to get that service, I might have paid $400 somewhere else. It is absolutely staggering how opaque this is, and I'm not thinking this is going to get better in the near future.
Right, and so I'll give you a couple of other examples, and then we can wrap it up. But private equity firms have also owned hospital chains, and there are a couple of bad examples, but the worst right now is a hospital chain. No, not the worst, but among them, called Steward Hospital. Steward was formed in 2011 when Cerberus Capital, which is a private equity firm, bought about 6 Catholic hospitals and nonprofits, and it had to do certain things to comply with what the Attorney General wanted it to do, invest in it for a while. But after 4 years, it was freed of that. And in 2016, it took all of the property from underneath the hospitals, sold it, and took that and then started went on a buying spree of hospitals all over the country. And then put all the debt, that outsized debt, on the Steward hospital system. And then it is now, so it was able to get out its money because it keeps selling off the property.
Right.
And there was a recent example, which is particularly under COVID, when a small hospital in Easton, Pennsylvania, that we've written about, it was owned by Steward, and Steward went to the governor of Pennsylvania and said, we're going to close this hospital unless you give us bailout money. Now, there are lots of hospitals that are doing badly. It just so happened Easton was doing worse because Cerberus, Steward, had sold the property underneath it that it had owned since 1890 when the hospital was first formed.
Wow. And so that land is probably a prime location and worth a lot, but now the hospital doesn't own it, and I'm assuming is paying rent to stay there.
Exactly. And so that if you want to know why the finances of this particular hospital are crippled compared to lots of hospitals are doing bad, but private equity was first at the bailout trough to get money and threatening to close the hospital when there were patients from COVID standing at the door.
Absolutely horrific. Are there any other books that you guys are working on that I'm not aware of?
So we've just, we haven't done a book. We've done lots of these reports on different sectors. So the healthcare sector, we have articles on grocery store chains is another example of where in between 2015 and 18, there were 7 bankruptcies in regional grocery store chains, all affiliated with private equity, but no publicly traded grocery store chain in the same period went bankrupt. So when people talk about like the retail apocalypse or e-commerce being the main culprit, what we find is behind the scenes, it is the financial dealings that particularly make these companies vulnerable.
And I'm assuming that with these grocery stores, some of them are part of why we have so many food deserts now, where people in big cities have literally nowhere to go buy groceries.
Well, I haven't done a study on that yet,
Okay.
but maybe that'll be my next one.
There you go. Well, Rosemary Batt, thank you so much for spending this time with me and my listeners. I do expect a lot of emails about this because they're going to love it. Is there any closing comments or books that you would recommend if someone wants to do further research beyond your book, Private Equity at Work?
I would just say that there's a lot of articles now coming out about what I would say, private equity bad behavior in prisons. Private equity basically dominates all of the prison services and telecommunications, commissaries and healthcare, in dollar stores, in lots of different kinds of retail. And if you Google private equity and different sectors, a lot of that will pop up in the from the alternative press. So there's a lot of people very concerned about how private equity is undermining, basically small businesses and Main Street stores. So that's where I would look.
Yeah, well, I was already freaked out. That did not help. That did not help at all. But, this is why I wanted to cover this topic, because it's mostly hidden, and I think my listeners need to know. So, Rosemary, thank you so much for your time, and I do greatly appreciate you being on The Phil Ferguson Show.
Okay, thank you so much. Bye-bye.
You're listening to The Phil Ferguson Show.
Thank you so much for listening to The Phil Ferguson Show. I greatly appreciate it. Hopefully, the little mailbag segment on international funds helped explain a little more that maybe you did or didn't know about international funds and how they work. And, of course, the profoundly disturbing interview with Miss Rosemary Batt about private equity. And, of course, you can check out their book and get it in any good bookstore. And, of course, Amazon, any internet-based bookseller. The title of the book, again, Private Equity at Work, When Wall Street Manages Main Street. I have seen many, many books on this topic, but none of them were as good as this, in my opinion. Maybe I'm missing something, so if you know of a better book, let me know. But often they're trying to sell you on the idea of private equity and how good it is and how you should get in and get your share. I disagree. I think the data is clear that they sub-performance for you, the average person, maybe above average performance for the really rich who set up private equity funds and take over companies and often fuck them up and sell them for pieces and break them apart and screw taxpayers, screw lenders, screw employees, and their pensions, if pensions are still a thing in that company. So all that being together, I'm going to give a hard no on private equity. And I know one thing that has come up, I just thought of in a few phone calls and a few emails, is still a very popular idea. I think I'll do a whole segment on this coming up maybe, of these apps. Acorns, Betterment, Wealthfront, all those different things. I did in the past, a year and a half ago, a thing on Acorns, and then I think I did one on Betterment. I can't remember which one it was now. But I kind of come to the conclusion that you should not use these applications because they can have hidden problems. And it's not that every single one of them is bad. It's that every single one of them that I've spent the time to research and dig into have problems. So I'm going to assume that they all have some kind of problem until I find one that doesn't have some kind of problem. But Acorns in particular was one that they hold your investments in their name, not your name. So if Acorns goes bankrupt, there is a chance that you don't get all your money back. That generally is not even possible at big qualified custodians like Fidelity, Vanguard, T. Rowe Price, whatever, E-Trade, all that stuff, because it's always held in your name in an account with your name on it. And if the company goes bankrupt, the people collecting debts that they're owed by the company can't come and take your money. That's because it's your money. It's got your name on it. So that's one of the problems that concerns me with all types of those accounts. You need to know how it is truly and really owned. And again, any of the big brokerage firms, you can set up an account, and often you can open an account with no money. Vanguard does require a minimum of $1,000 to start investing, but some others are free, or the amount is zero. You can connect them to your bank just like a cool, sexy app. You can send money once a week or once a month, just like a cool, sexy app. And that would be your job, is to put more money in there. I really don't see the benefit to your long-term investing success of having a pretty interface on your phone and being able to check your portfolio every day on your phone. And quite honestly, that might be a detriment. So some random thoughts there that I wasn't really going to go into. Other things, I'm practicing my Italian. I told you that with in-person talking time online, but I've also been watching a lot of Marvel movies. And it turns out that Marvel, in their wisdom, wants to be watched in more countries than those that speak English. And so they actually translate a lot of the content into multiple languages. And I think everything I checked so far does have Italian. So I'm now listening to these things in Italian with the English subtitles. And I think only occasionally check for the subtitles. And sometimes I can even avert my eyes from the screen and hear what they're saying and know what's going on. It's getting so cool. I used to think my brain was broken and I couldn't learn a second language. So I'm very happy. Taking a lot of time and effort and work, but it's generally good fun. And I started a Marvel TV show. I guess it's still called a TV show, an episodic program. The Iron Fist, couldn't do it, folks. Couldn't make it through the first season. The character was just so pathetic and whiny. I just couldn't. And so I stopped watching that, and I went to, I think it's The Defenders, and the opening scene included the Iron Fist. Now, I talked about this a little bit on Facebook, and people are like, Phil, apparently you don't know much about Marvel comics and the history. No, I don't really know shit. And I'm okay with that. I'm just watching a freaking show for entertainment and trying to learn Italian. But I have my limits. Some shows I find unentertaining, unwatchable. And so the Iron Fist was one of those. I watched The Defenders, which ended up being about 20% about the Iron Fist. But, it was okay. I did finish that. And now one of the other characters, it turns out, has 3 complete seasons. And I seem to like the character in The Defenders, and that's Jessica Jones. So now I am starting season 1, episode 1 of Jessica Jones. There's 3 whole seasons, so this should give me a lot of Italian audio to listen to and practice some more. Other quick reminders, if you like the show, I would be happy for you to go to iTunes or Apple Podcast, Stitcher, and leave a 5-star review. That benefits me a whole lot, because sometimes people will look there and see all these wonderful reviews and go, hey, that's a show I should listen to. So if you can do that, I would greatly appreciate it. If you want to throw a few bucks my way, I would appreciate that as well. It's just kind of a little sign saying that you appreciate what I do. And you can do that at patreon.com/Phil. I did notice a couple of users after the last show, I think it was just one show ago, maybe it was 2 shows ago, switched from $1 or $2 up to the top tier, which is $6.66 per episode. It's not deducted weekly or monthly, so if I am late getting out a show, you're not out any money until the show comes out. But if all you can swing is $1, that's great. If you can't even afford $1, the 5-star review is very nice. And of course, my goal is to try to get this close to an hour, and we're way over that. I have heard that every single conference that is secular, humanist, atheistic, free thought, whatever that I know of for the rest of the year, they're all canceled. Coronavirus, yay. And of course, we're setting new records. Oh, actually, let me see if I have this. I love this website called worldometers.info. And it's doing a really good job, I think, of tracking coronavirus cases. And yesterday we had 75,000. 75,000 new, and I like to say new known cases, because there are people that are sick or mildly sick or asymptomatic that are sick that just don't get tested or don't go to the doctor. So clearly there's more cases than the 75,000 new known cases. Delightfully, the death number, as not low as this is still under or around 1,000 per day, not the 2,000 or 3,000 that we saw months earlier. I think there is reason to believe that part of that is because of the lag time from people getting sick to people dying, so maybe those numbers will go up. But there also might be merit to the argument that this virus first spread in poor communities and elderly communities like nursing homes. And so when a higher percentage of the population infected is older, you're probably slightly more likely to die. So hopefully it won't ever get as high as it was. But we also have problems where the data is just not particularly good. I mean, it's better than nothing, but we don't know for sure everyone that's affected. We don't know for sure everyone that passes away, but it's still serious enough that I'm trying to avoid going out whenever I can. And of course, if I do, I try to social distance. And even if I can manage that, I wear my face mask, which I understand is not 100% perfect, but it's way better than not wearing a face mask. And I'm very, very annoyed and frustrated. Sorry, I'm going to go into a rant here. It's the end of the show, but it's here now, so I got to do it. This idea that you can't wear a face mask because you can't breathe and it doesn't work. And of course, the size of a oxygen molecule is an incredibly teeny fraction of the size of a virus. So if you're concerned that it blocks oxygen, it by definition has to block virus because there's no freaking way it can get through. So wear your face mask. I've heard a couple people say this way. The funny one is my body, my choice, which I'm like, okay, theoretically, I agree with you, your body, your choice, but why don't you think that women should have the control over their body? But that's a whole other subject. The other one that I hear is when people say, I choose not to wear a mask and I'm going to take personal responsibility for myself. What the fuck does that mean? Personal responsibility. I know you said it, but what do you mean by it? Do you really understand it? Does that mean when you take personal responsibility, if you get sick and you need medicine and medical treatments and hospitals, if you're taking personal responsibility, are you going to pay all those bills out of your pocket? Are you going to go to your insurance provider and say, hey, no, this is on me. I took personal responsibility and I'm going to pay the bills? What if you get someone else sick? What if your family member, a relative, an elderly parent, a neighbor gets sick because you got sick and you gave it to them? Are you going to pay their bills? Are you taking personal responsibility to the point of all the people that you interact with? Or are you only taking responsibility for yourself and fuck everybody else that might get sick from you? So just something to think about. It's not that fucking hard. Please, I beg you, put on a mask when you're outside, when you're near people. You may be sick and not know it. They may be sick and not know it. And your mask helps you stay healthy. And of course, if they have on a mask, it might even be more helpful to your health because then the particles can't move to you. So anyway, I didn't expect that little rant. My apologies. This is going to be the wrap up for show 348. We're in July of 2020. And I would love to see you in person, but apparently it's not going to be anywhere in the calendar year 2020. Hopefully in 2021, we can go back to some kind of normal. I'm not optimistic it's going to happen by the spring of 2021. So we'll see what happens. Until then, ciao.